When companies, governments or corporations need to raise money for funding a project or maintain existing projects, instead of obtaining loans, they may issue bonds to investors. These bonds are contractual agreements by which the issuer of the bonds agree to pay the investor the interest along with the principal after maturity. These are called debt instruments. Let's look at who can issue debt instruments. Any company or corporate that has a good credit rating can sell debt instruments. This implies that any company of good repute and repayment or debt discharging ability can sell debt instruments. For classification purpose, we classify debt instruments as bank or non-bank. Banks, being one of the oldest and most reputed financial institutions, issue the maximum number of debt instruments. Some experts even consider saving accounts as debt instruments, as the bank pays an interest on the money deposited and loans out the money at a higher interest rate. Some of the commonly used bank debt instruments are federal funds, negotiable CDs, euro-dollar deposits, bankers' acceptances, credit cards, bonds. Other non-bank financial institutions also issue debt instruments. Their value is based on their credit rating. Many non-banking financial corporations, NBFCs, are also involved in selling debt instruments in open market and to specialized buyers. Let's take a look at the debt instruments issued by non-banking based entities. A list of common non-bank debt instruments is given below: bonds or debentures, treasury bills, repurchase agreements, repo returns, commercial paper, short-term municipal securities, money market futures. In addition to banks and NBFCs, the government is a popular issuer of debt instruments, popularly known as sovereign debt. Government issues debt to raise money from the market for growth and developmental projects. The purpose behind the issuance of debt from the government can be to raise funds or to control the amount of money floating in the market. A very popular government debt instrument is Treasury Bill, T-bill. Let's now explore the debt market. A debt instrument may be tradable or non-tradable depending upon the terms of issue of the debt instrument. Quite a few debt issues are not tradable. In the debt market, fixed income securities of various types and features are issued and traded. For example, for debt arising out of a specific agreement between two parties bearing conditions that can be fulfilled only by the specific parties, then the debt automatically becomes non-tradable in nature. These clauses are incorporated in the agreement to protect the rights of the issuer. Debts that are tradable get most of their liquidity from the secondary market. Secondary market provides one of the best places to buy or sell debt instruments through the auction mechanism.